Assalamu alaikum friends, welcome to question number 53 Gasnature from your SBR revision kit. And in this question we are going to cover multiple standards. For the first requirement, as you can see, Gasnature wishes to know how to treat the agreement with Go Gas, including any obligation or possible obligation arising on the underground storage facility for 7 marks. Okay, from that we will not be able to understand appropriately what is the specific standard because the wordings are such. Okay, whereas in the second one specifically you know which standard because they have mentioned IFRS 9. So gas nature wishes to know whether the contract with Agus should be accounted for under IFRS 9, 6 marks. So one standard is IFRS 9, which is a major challenging standard which we are going to cover. And if you see, part B is uh, where I want to take your attention to, because number one, professional marks is there. Number two, IS 20. This standard is not commonly asked. Okay, but when it is asked, how you have to account for this. And with that, we have IS 16 also. So outline the main accounting choices permitted by IS 16 and IS 20 and discuss the impact of this on the investor analysis of financial statement for 10 marks. And if you see, case study is very small. Why is it that it is for 10 marks and with professional marks? Why is it so? Because it is regarding analysis, and I have covered this in my lecture analysis. This is a section for analysis which is covered in your section B questions. Question number 4, which is with that you have your 2 professional marks. Your first 2 professional marks are for your ethical questions. In question number 2, the other 2 professional marks out of the 4 is for your this question, which is for analysis, which comes in your question number 4 in section B. That's why ethics and analysis, you can never miss out on those questions. You need to know this because professional marks are attached to this. Professional mark, okay, this word, if you pronounce professional marks, it looks like something very sophisticated. Oh my god, it's very difficult. I will not be able to score this marks. No, in fact, professional mark is something which is easiest. It is easy to get than your technical marks also. Because number one, the way you presentation. That's why they told quality of presentation, the way you present. Second, the points that you are making, the way you are arguing. Understood? The more depth is there in your discussion, quality full discussion you are making. I'm not talking about quantity, I'm talking about quality. There are more chances that you are able to attract the professional marks. And this 2 marks is easy. One definitely for the format that anyone can get. Regarding the other one mark, which is for the quality of a discussion, that also will come. Okay, that also you can you can earn, but for that you need a lot of reading, wide reading, a lot of practice, okay, to have depth in your discussion. That means you need to know that, understand in and out to discuss on that. Usually in this scenarios only you will be able to get the 2 professional marks if you have a depth of understanding in this particular standard. Otherwise it's very difficult. Okay, so yeah, 10 marks. Analysis questions are usually for 10 marks, 10 marks, 8 marks, 12 marks. It has a huge amount of marks with it because analysis is something which looks, it is from the face of it, when you read this, it's not easy to do analysis. Analysis is something more than that. You are adding a value to it. You're looking at from different angles, different scenarios. That's why analysis has 2 professional marks also. Okay, so we'll come to that later, but first we'll finish those 2 parts, which is much easier than that, because this we know a specific standard, we can easily do it. But analysis is something which, even no matter how much you have studied on analysis is something which you need to develop over a period of time. Okay, and some people are generally they're specifically skilled in analysis. They can do deep analysis. They have this research mind, always, switch on and switch off. They can research, they do research, they know from various angles how to answer this question, not from one particular angle. But for those people who are generally not good in analyzing so much, it's okay. You need practice over the time, you'll be okay with it. But If you're good in analysis in your SBR, remember this will help you in your SBL exam also, and in your other papers also where analysis skill is needed. Because with this analysis skill, you need analysis skill, especially in professional level papers. Whatever paper you do, you cannot skip that. Analysis means you have to look at the financial things, you have to look non-financial figure, you have to look additional performance measure, you have to look ratios, you have to compare ratios, do your own ratios, calculate it yourself, and then say, give the reasons, insight to it, why it might be like this. That is the meaning of analysis, not just recognition or measurement. Okay, so let's come to our first requirement. Under A, first requirement. Gasnature is a public limited company involved in the production and trading of natural gas and oil. Looking at the word Gasnature only, you know it's regarding something gas. So gas and oil. Prepares its financial statements in using IFRS and readers require advice about the accounting treatment. Okay. Gasnature jointly owns an underground storage facility with another entity, GoGas. Both parties extract gas, which they own and operate independently from each other. Gasnature owns 55%, GoGas owns 45%. They have agreed to share services and costs accordingly, with decisions regarding the storage facility requiring unanimous agreement of the parties. That means you need agreement from both parties before taking any decision. Local legislation requires decommissioning of the storage facility at the end of its useful life. You have to decommission that storage facility after the use is over, at the end of its useful life. How are you going to treat the agreement with GoGas? Number one is regarding the agreement with the Gasnature and GoGas and any obligation or possible obligation arising on the underground storage facility. There are two requirements if you see this very clearly. If you see this very clearly, there are two requirements in this. One is agreement, second is regarding the decommissioning of storage facility. Because decommissioning of storage facility means that is the meaning of obligation. They're talking about obligation. In short, okay, if I have to tell you appropriate standard, they're talking about joint agreements, joint arrangements. One standard is that. Okay, which standard is it? IFRS 11. And the other standard, which is regarding obligation, decommissioning, IS 37, provision, contingent assets and contingent liabilities. These are the two standards they're asking you. Okay, joint arrangements. They have given you two parties. See, you always need more than one party for joint arrangement. Joint arrangements can be more than one party. It could be two parties, three parties, for any parties. If it's more than two also, it still will be a joint arrangements. Okay. What is the word that will tell you whether there's a joint arrangement or not? Look at for this word. Unanimous consent. This word will tell you. If this word is present means it's joint arrangement. Unanimous consent means you need the consent from both the party. If it was not unanimous consent means you take decision from the one party, it's okay. You can carry out with the decision. But in this case, no, unanimous consent is needed. Okay, this is usually an indication of joint control. But the question is whether this joint control is a joint operation or a joint venture. If it's a joint venture, how are you going to account for it? If it's a joint operation, how are you going to arrange for it? Okay, you have to be clear. There are differences between these two. Joint operation is one thing, joint venture is another thing. Under joint control, both are joint control, but the way you operate is different. Okay, so you start with this. How do you start this answer? See, dismantling. Okay, we'll go to that later, but first we'll finish the joint arrangement part from 7 marks. At least 3 marks you should be able to get from this joint arrangement. One is to say whether they have a joint control or not. One is to classify between joint operation or joint venture. Third, after you have decided that it's a joint venture or this, then you account for it, measure. So a joint arrangement exists when two or more parties have joint control. Okay, joint control exists when decisions about relevant activities require unanimous consent. Okay, more than one party, two or more parties joint control. Second, unanimous consent. So 1 mark from this. Second mark, classification into joint venture or joint venture. So it depends on the rights and obligations of parties to the arrangement. Okay, now specify. What is a joint venture? What is a joint operation? Define. So a joint arrangement which is not structured through a separate vehicle is a joint operation. There is no separate vehicle. A joint operator accounts for the assets, liabilities, revenues, expenses relating to its involvement in the joint operation. If it's a joint operation, how do they account for it? They will take their share of assets, liabilities, revenues, and expense. Okay. Now, so this arrangement, is it a joint venture or a joint operation? The arrangement with Gogus is a joint arrangement. Correct? That we know it's a joint arrangement because unanimous consent is there. Because decisions regarding platform requires unanimous consent. You are agreeing that you are now applying this knowledge to your case study here. Okay. Joint arrangement because unanimous consent. This joint operation with Gokus should be classified as a joint operation. Why? Because there is no separate vehicle involved. If separate vehicle involved is a joint venture, then you will use IS 28 equity method that you use for associates. Same for joint venture also. But because this is a joint operation, IFRS 11 only. You will take their proportion. Gasnature will take their proportion. GoGas will take their proportion. So Gasnature should recognize 55% of the assets cost as property, plant, and equipment. It's an asset which will come under IS 16, right? Recognize 55% because they have 55% share. We don't care about GoGas. I mean, from the requirements point of view, we don't care about GoGas because you are only asked on Gasnature. Okay. So third for that. So 3 marks for this. First mark, I will repeat whether to say there's a joint control or not. Second, if joint control, joint venture, joint operation. Third, because joint operation, how do you recognize it? 3 marks. Now we are coming to the dismantling. Dismantling should give you 4 marks because out of 7, 3 marks are gone for joint arrangement. So under IS 16, okay, the cost of an item include the initial estimate of the cost of dismantling also is there. Remember, when you are taking the cost of an item, cost of property, plant, and equipment, with that cost, there is a cost of dismantling also that is involved. The initial estimate. Remember, that cost involves cost of dismantling also. You need to be very careful when you go through IS 16. What are the costs that are there? Cost of buying that asset or cost of making that asset. With that, cost of dismantling is also there. In case you forgot, you have to go back to IS 16 and see the list. There's a list. Cost of dismantling is also involved there. And removing the item and restoring the site on which it is located, this also are there. It's involved. Okay, so for this you will get 1 mark. Fourth, 4 points. Fifth, now we'll talk about IS 37. What does IS 37 talks about decommissioning? So they say you have to measure decommissioning and restoration cost and similar liabilities. They stipulate how you have to measure. Okay, so when the time value of money is material, you have to discount, otherwise don't discount. Okay, provision should be at the present value of the expected expenditure required to settle the obligation. 1 mark for this because they are using IS 37 to say how they are going to measure this. So how many marks out of 7? Wait. 4, 5. 5. 5 marks. 6 and 7. You see? Each point different paragraph. So the 6th mark. Gasnature account for 55% of the present value. Because assets, same thing for obligation. Obligation is a liability too. So liability also, they will account 55% of the present value of the estimated decommissioning cost. Gasnature will include this in PPE. Remember that. Because in your PPE cost of decommissioning also goes. That means present value of decommissioning cost also will be included in PPE. So Gasnature will include this and will also recognize a provision for the same amount. Provision has to be recognized for that amount. And finally, what is it? Because Gasnature is a joint operator, there is also contingent liability for 45% of decommissioning cost. As there is a potential obligation with some uncertain feature even occurs, such as if GoGas goes into liquidation and cannot fund the decommissioning cost. Most of you will miss out on this point, or you might not even think about this point. This is uncommon something which came up for this paper because normally this does not come, right? We talk about that proportion only, Gasnature. Now they are talking about 45%, which is the share of GoGas. The joint operator, the next one in the joint operation. 45% is go gas. Why Gasnature has to recognize that their decommissioning cost? This they will recognize as a contingent liability, not a liability, contingent liability. 55% share of Gasnature, normal liability. But this 45% of their joint operations, which is go gas, that they will recognize as a contingent liability. Why? Because they are in the joint operation. So if one of them default or goes into liquidation, the other party has obligation to pay that. Understood? It's like a partnership, unlimited partnership. When one party is not able to pay that one partner, the other partner, the obligation falls on them. They have to do it. Okay, so if go gas goes into liquidation and cannot fund the decommissioning cost, Gasnature has to pay that 45%. They have an obligation. That's why contingent liability. Why contingent liability? Because it is yet to happen in the future. You don't know in the future whether go gas will go into liquidation or not. It's just an uncertainty. If they don't go, it's okay. You don't recognize anything. But if in case go gas goes into liquidation, then only for Gasnature you have to recognize contingent liability. Therefore, Gasnature should disclose a contingent liability. You don't recognize, you have to disclose. Okay? This is provision, this is contingent. Two things are there. So, Gasnature should disclose a contingent liability to the extent that potential liable for Google share the decommissioning cost. Okay? Up to the extent that they are liable for the GoGas share of the decommissioning cost. Up to that extent, they will disclose contingent liability. Okay? So, that's it. Now we are coming to the financial instruments. Make sure that you go through IS 37. Mind you, IS 37 is another standard which every sitting I see IS 37 asked. Okay, so make sure that you do. Joint arrangements, not very frequently, but joint arrangement can come in your group accounting also in your question number 1. So make sure that you go through that also. But as a standalone question in section B also, IFRS 11 can come. So group accounting question can come in section B also. It will definitely come in section A, first question 30 marks, no doubt, but in section B it might come. Okay, probability is there. You cannot say it will never come because in question 1 group accounting questions came. Group accounting questions means what are the standards of group accounting? Associates, IS 28, joint arrangement, IS 28. Understood? IFRS 3, business combination, IFRS 10, consolidation. So this standards, these are group accounting questions mainly, but this can come in section B also. So you have to be prepared from the both the angles, whether section A or B. Second, Gasnature has entered into a 10-year contract with AGS for the purchase of natural gas. They have made an advance payment for a gas for an amount equal to the total quantity of gas contract for 10 years, which has been calculated using forecast price of gas. Advance carries interest of 6%, which is settled by way of supply of extra gas. Fixed quantities of gas have been supplied each month, and there is a price adjustment mechanism in the contract whereby difference between the forecast and the prevailing market price is settled in cash monthly. If AGS does not deliver gas as agreed, Gasnature has the right to claim compensation at the current market price of gas. This is regarding a contract. 6 marks, okay? Marks are less. But you have to know how to collect the 6 points. That's the important thing. If you don't know how the 6 marks are given to you, it will be very difficult to write financial instruments because financial instruments is a very big standard. But you need to understand what specifically they are asking you in that standard. Okay? They're talking about a purchase contract. The main theme is regarding a contract, purchase contract to purchase. Okay? If you see the answers are also not so big. 6 marks. So what is it? It's a contract, understood. What type of contract is it? To buy what? Gas. Gas is what? It's a financial or a non-financial item. Understand this. Whenever they talk about contract, I will divide this for you. Any question, whenever they give contract under IFRS 9. I'm talking about IFRS 9. Divide it. Financial or non-financial. Because if it's a financial contract, treatment will be different. If it's a non-financial contract, treatment will be different. Most of the time, the contract that they give is non-financial. Because there are specific reasons for they want to test that area of you. That's why they give non-financial most of the time, but they might give you financial contract also. How do you know whether it's a financial contract? something money related, something where you can obtain cash, you have a right to receive cash, through which you have a right to receive cash. Okay, but in this case it's non-financial because it's a contract to buy gas. For example, commodities like gas, oil, gold, silver, diamond, contracts to buy like this, those are non-financial contracts, and those are the contracts which usually is given to you in the exam, like contract to buy coffee, cocoa, tea, anything like that. Okay, so it's a contract to buy a non-financial item. You can have a contract to buy as well as contract to sell also. In this case, it's a purchase contract, contract to buy, that are settled net in cash. Such contracts are accounted for as what? You need to know what is the word? Derivatives. So under IFRS 9, the main word is derivative. We are dealing in derivatives. Understand this point. Derivative is not very difficult. It looks difficult from outside. It's not very difficult. You dive in, it's very easy. Unlike your financial instruments, equity instruments, debt instruments, financial assets, financial, this are more complicated than derivative, because derivative is very straightforward. Okay, fair values through profit and loss only. No options like amortized cost, fair value through other comprehensive income, nothing like that. Okay, standard is it's fixed. Mostly this type of question is very standardized. Same question comes different times. Okay, different times the same question has came. Maybe the commodity they changed. In this case, it's gas. Sometimes they might give you gold. Sometimes they might give you cocoa, right? Contracts which are for an entity's own use of a non-financial asset are exempt from the requirements of IFRS 9. This also you need to understand. So if you see, okay, one is it is derivatives. To identify the derivative, 1 mark you will get. If it's for entity's own use, exempt. There are various ways in which a contract to buy or sell a non-financial item can be settled net in cash. This include how they can be settled net in cash. 4 points. Pure knowledge. You might not get all these 4 points. You might only remember 1 or 2 points. Still write it. Whatever the points you remember, 1 point, even if it's 1 point, just write it. You will get marks for it rather than not writing it. There are various ways through which you can settle net in cash. How? That's what they are telling. When the term of the contract permits either party to settle net in cash. See, you cannot settle net in cash always. That's why you have to give these requirements. In which conditions you can settle net in cash. That's why you have to give these reasons. Otherwise, you cannot. It's not common to settle net in cash. You cannot do it unless out of these 4 things are there. One, when the contract permits you that either party can settle it net in cash. When the contract says it so, that either me or you can settle it net in cash, then you can settle. Second, when entity has practice of settling similar contracts net in cash. In the past, they have been settling similar contract like to yours net in cash. Then also they can settle net in cash. Third, entity has a practice of taking delivery of non-financial asset. They finally take the delivery. They take it. They buy it, gas at the end, and selling it in the short term to generate a profit. Understanding? They are taking the delivery of the asset and then they are selling it to generate a profit in the short term. That condition also settle net in cash. Fourth condition, when the non-financial item is readily convertible to cash, then also you can convert to settle net in cash. If these 4 conditions are there, out of this 4, if one is there, settle net in cash. If not, if these 4 conditions are not there, not all 4, at least one, then you cannot settle it net in cash. You have to look for this 4. Out of this 4, which one is there? If none of this is there, you cannot settle net in cash. And if you cannot settle net in cash, then it will not be a derivative contract, because derivative contract, look at the definition. To buy a non-financial asset that are settled net in cash, and this net in cash you brought down further in the next paragraph. That's how you're going to get the marks. That's how you're going to get, let's say 2 marks for this. So 1 and 2, 3 marks. Out of 6, 3 marks already gone. Okay, here also you're going to get 1 mark. 1 mark for derivative, second mark to say it is exempt if it's for own use. Third, the other 2 marks for this thing, when you can settle net in cash, and out of 6, the other 2 marks. 1 for this, 1 for this. That's how you're going to get the 6 marks. So in this case, whether you can settle it net in cash. So it could be argued that contract is net settled because the penalty mechanism requires August to compensate Gasnature at the current prevailing market price. In this case, you can settle. Why? Because you have to pay compensation. August have to compensate Gasnature. It's like a penalty at the current market price. If natural gas is readily convertible into cash in the location where the delivery takes place, the contract could be considered net settled. Yes, because out of this 4 bullet points, which one is this? Readily convertible into cash is the last point, fourth point. Okay, you see, fourth point is applicable here. If it is readily convertible into cash, that means when you deliver it, you can get the cash also. The moment you deliver the gas, you can get the cash. So it's readily convertible into cash, the natural gas. In that case, settle net in cash. And finally, whether it is under IFRS, because sometimes it might be under IFRS 9, outside IFRS 9. It does not fall in the scope of IFRS 9. If it falls inside the scope of IFRS 9, you have to account under that. If not, you have to say it is outside the scope of IFRS 9. Mostly for this type of contract. The contract will probably still qualify as own use. You see? As long as it is entered and continues to be held for Gasnature's usage requirement. That means Gasnature wants to use it. For their requirement, it will still be qualified as for own use. Because it is qualified as for own use, this means it falls outside the IFRS 9. IFRS 9 you cannot use. It is outside the scope of IFRS 9. IFRS 9 does not deal with such type of contracts. It should be treated as what then? Alternative? Executory contract. Executory contract. Something which is for your own use. And non-financial also. That's the meaning of executory contract. So if it is an executory contract, how do you deal with it? Gas will be recorded at cost on the purchase date. What is the cost of purchasing that gas on that date? You recognize it at that date. Okay. It is the contract to buy what? Gas. Now, coming to part B. Accounting policy choices, 10 marks. We'll read it. They are institutional investors, investor participation entities, gas entities are considered certain IFRS and IAS permit choices between different measurement bases and presentation methods. They believe that thus choice hinders its shareholder from comparing Gasnature to other entities on like-for-like basis. They think that giving these choices is not good because it becomes harder to compare Gasnature with other entities. That's the theme that you have to talk about. So now you have been given two standards, IS 16 and IS 20, to talk about that. Okay, 10 marks when you're talking divided among the two standard. Okay, when you're taking the division, don't take the profession marks. 2 marks is keep it separate from the 10 marks. Okay. Now, presentation, as I told you, definitely for other questions also you need to pay particular attention to the way you present your answer. It has to be something which is understandable, something which is easy to read and understand. But especially for this question, you need to pay more attention. No choice. Because professional marks is there. So you start with IS 16 like this first, and then we'll talk about IS 20. Because definitely IS 16 you'll be getting more marks because there you can talk more about it compared to IS 20. It's a small standard. So take time to think about the choices that is allowed by each standard. See each standard. Why this both standards are given? Because under this both standards there are choices. This is the gateway into the rest of your question. The rest of the question sets out from here. What are the two choices that IS 16 gives? One is cost model, one is evaluation model. You can either measure it at cost or evaluation. Cost means cost minus depreciation or impairment losses. Revaluation means fair value minus depreciation and impairment losses. Okay. So for that, 1 mark to give the choices between cost and fair value. Okay. Next is what? Just give me a minute. Okay. So out of that, one second is this. Second point is what? You always have to talk about impact on the user, investor, because you are doing an analysis. Just giving the two valuation model is not enough. What is the impact of this on different financial statements that you have to talk about? So assume. See, assuming. You are giving an assumption, some example. Through this also you can get your professional marks. One of the two professional marks you can get because you are giving more insight. Through what? You have no facts. You're not using IS 16 rule now. Now you're assuming, you're imagining something. You're giving some examples from your own that you can give. Any example you can give. But let's take, this is a very common example. For your safe side, better you also use this example only. Assuming property prices are increasing. We are talking about property because we have to talk about PPA 16, one item, right? If their prices are increasing, an entity that revalues its PP to fair value will record lower profit than one that uses the cost model. Use examples like this to tell. If this happens, this will show lower profit, that will show higher profit. Under this model, this will happen. Under that one, that will happen. Why lower profit? Why the one which revalues to fair value will show lower profit than the one who's using the cost model when the property prices are increasing? Tell me that. See, uh, revaluation gain, okay, are not recorded in profit and loss. That's why. If it's cost model, value goes up, still using cost model, all the gain will go in the profit and loss. That's why it will show higher profit. But when you are changing it to the revaluation model, fair value, it will go to OCI, other comprehensive income. Remember IS 16 fair value model gain? IS 16, sorry, OCI. It will not go to profit and loss. That's why they will show a lower profit. That's why revaluation model will show a lower profit than cost model. Okay, they have mentioned it all here that gains from revaluation recognized as sort of profit in other comprehensive income. Even the depreciation charge on the revalued asset will be higher. That means cost under the expenses under the revaluation model will be higher than the cost model because depreciation also will be higher now. So because of this, revaluation model will have a detrimental impact on the stakeholder. When the stakeholder wants to assess the entity's financial performance, okay, if they're using revaluation model, it will be having a detrimental impact. Stakeholders will not be so much happy because it will show a lower profit because high depreciation and gains are an OCI, not in profit and loss, so higher profit loss. Sorry, not lower profit. Moreover, the higher asset value recorded in statement of financial position. Under the revaluation model, even though profit is less, but in the asset value, in the statement of financial position, asset value will be higher. Might also make the entity look less efficient than the one which uses cost model. Because it makes them feel, the user, the investor, it makes them feel that you are having so much of asset, so much of money is tied up in your non-current assets. Rather you could have invested that money somewhere else. Understood? So out of two, at least I think 3 marks you should get here because one impact we are showing on the profit, the other one you're talking about in the statement of financial position. So 3 marks. 1 plus 2, 3. Okay, sorry, this will just keep it 2 because financial position is in this side, third. But there is a positive side also to that. What is it? Positive side, revaluation gains. When there's a revaluation gain, positive side, it will increase your equity in the statement of financial position. Because your equity is increased, your gearing ratio will improve. Improve means it will go down. Because equity is increasing. Understood? So this will make entity look less risky investment. It will make you look less risky. Gearing ratio improvements, you are less risky. Because some stakeholders may place importance on the entity's asset base rather than their profit. Because through this asset you can use it as a security for obtaining new finance. For example, when you go to the bank to get a loan, what does bank says you? As a security, as a collateral, you might have to give some of an asset. You have to pledge to some of your asset. Against some of your asset only they will give you loan. So having a high asset base means you can secure more finance through that asset. So it's good for them. You see from so many angles this is the analysis only that you are doing. You're talking about finance on that asset, you're talking about the gearing ratio, you're talking about less risky because equity is improved. So many things, right? Does higher PP value could be viewed positively, the statement of financial position. Now, fourth, let's divide equally five points for this, 5 for IS20. So, fourth mark is for this, and fifth mark is definitely for disclosure. Now, we're talking about revaluation. Another thing to note is that revaluation model, because of revaluation, it will make the asset position more volatile because asset value keeps changing. If it was cost, okay, we know one cost, will keep on using that only. But revaluation, every year it changes. So asset position becomes very volatile, which is not so good. So volatility, remember, can increase the perception of risk. More volatile it is, more risky it is. But the statement of profit and loss will be less volatile than the statement of financial position. Why? Because revaluation gains are recorded in other comprehensive income, not in profit and loss. And other comprehensive income items does not change very so much. And even if it changes also, it will not affect your profit and loss because statement of profit and loss, it will not go. It will go under comprehensive income. And fifth, disclosure. We are going to talk about disclosure. Don't forget disclosure under both this and this. We talked about recognition, we talked about measurement. Disclosure is also important. If you are using revaluation model, you need to disclose the carrying amount. Okay, that would be recognized if the cost model has been used. What is the meaning of it? Even if you are using revaluation model, when you are disclosing it, you have to disclose what is the cost. Under the cost model, what is the carrying amount? You have to disclose. Why? To enable better comparison. Such disclosure would enable better comparison with entities that would account for P using different measurement models. See, even in the statement of financial position, you are using the carrying amount based on revaluation model. But at least from your disclosure, they will be able to know what is the cost model also. The reason is that if you put it under disclosure note, at least some entity in the similar industry to you is using cost model. Through your disclosure note, you can compare what is your cost versus their cost. They might be using cost model, you might be using revaluation model. That's hard to compare. So how we are going to reduce this comparison? Comparison risk. Enable better comparison by disclosing it. And that means you have to disclose, you have to give both information. Under evaluation model, what is the carrying amount as well as under cost model. Under evaluation model, you are giving it in the statement financial position. Looking at it, you will know. But carrying amount of the cost model, you will be disclosing it under the notes. So through that, you will be able to know the cost also. Coming to IS20. Balance 5 marks you will be getting from here. Okay, your answer does not need to be detailed as the one presented below. Please understand this. Okay, so I'm not going to read each and every word. I'm just going to cover the main points. Under IS20, it is regarding presentation. You can present it in two ways. Two ways means when you're having some grant relating to an asset, you can present it in two ways in the statement of an asset position. This is important. This has to be there in your answer. One is that grant that you are receiving, recognize it as a deferred income and release the profit and loss over the useful life of the asset. Because grant is not just for 1 year, maybe for 2 years, 3 years, you're using it. So recognize in the statement of profit and loss as a deferred income and release the profit and loss over the useful life of the asset. The value of the grant. It's like depreciation, how you're taking the value of the asset and depreciating it, dividing it over the useful life of the asset. That's how for the grant also you're doing it. Another way you can do is deduct the amount of the grant from the carrying amount of the asset and then depreciate the asset over its useful life. That also you can do. Okay. So now you always have to say whether something will be affected or not, because remember, when something is there does not mean always it will be affected. Always your profit, no. Sometimes your profit might not be affected. Sometimes your net assets might not be affected. Like in this case, overall net asset and profit will not be affected by this choice. Having whatever the method you choose, whether this or that, it will not affect your overall net asset as well as your profit. But investor analysis of the financial statements, it can have an impact on this case. For this, you will get 1 mark, by the way, to talk about two presentation. And from rest all, you are going to get 4 marks. Let's see how many paragraphs are there. Yeah. So just divide the marks accordingly. Okay, I'm not going to exactly pinpoint these points, but we'll see. Okay. If you are using a deferred income method, then you are going to report a higher non-current assets and higher liabilities than the entity that uses a netting off method. Netting off means you are deducting the grant from the carrying amount of the asset. Definitely, because you are having a deferred income, you are going to recognize it as a deferred income. Okay, higher non-current assets, because your netting off means what? Grant, your carrying amount of your asset will go down because you are deducting the amount of the grant from that. Asset value will go down, but in the deferred income you are recognizing that grant further, so deferred income will go down. That means non-current assets will be higher, and even your liabilities will be higher. Why? Because you are releasing it over the useful life of the asset. So 1 mark for this. Then reporting a high level of liability, reporting a high level of non-current assets. Another mark for this, another mark for this. How many marks? High level of liabilities. If you are reporting a high level of liabilities, it will have a detrimental impact. No one wants to show a high level of liability because it will affect your gearing ratio. Okay, it will affect certain ratios. One is current ratio. Higher liabilities may also increase your financial risk also. That means your investment, no one wants to invest. It will be risky. Second, if you are showing a high level of non-current asset, this will be viewed positively. It can be viewed positively because you will be having a strong asset base, or it will be viewed as negatively also because entity may look less efficient at generating its profit because too much of cash is lying on that non-current asset. It is lying idle, right? With regard to income related grant, see, this is regarding asset related grant. Okay, there are two types of grant. One is asset, one is income. When it is, this is regarding asset related grant that you can present in these two ways. Now we are moving into the income. So with relate to income related grant, two methods of presentations are allowed in this case also, in the statement of profit and loss only. This is regarding income. One is present the grant as other income. Second, deduct that grant as present the grant as a reduction in the related expense. Okay. So in this case, overall profit will not be affected by this choice also. We'll go up and see. Because if you show it as other income, profit will go up. And if you deduct that grant as a reduction in the related expense, from that related expense you deduct this grant, again your expenses will go down. That means again your profit will go up. Both cases profit will go up only. So overall profit, that's why will not get affected by this choice. But still, when analyzing financial statements, this can have an impact. How? An entity that presents grant income by reducing its expense, they will be perceived as having better cost control, right? Your cost will go down. Okay, that means you're operating with greater efficiency than entity that records it within other income. Because if you show it in under other income, we don't know what the cost, but when you're showing it as a lower cost, deducting it from expenses, that means your cost will go down. Cost goes down means it shows you are improving, you're having a better control over your cost. But if you show it under other income, no one will understand what is the impact on the cost. It just shows that other income. Other income is something which is not recurring, it does not recur. So through that you cannot analyze it in a better way. From the point of profit, no effect. But from the way you are analyzing the financial statements, yes, that choices will have an impact. How it will have an impact? This way. This is how you need to answer this question. Okay. Now cash flow. So accounting policy choices have no impact on the operating, investing, or financing. See, they told statement of financial statements. Under financial statements, cash flow also comes. That's why we're talking about this here. Not just profit and loss and statement of financial position. This, if you want, you can write. If you don't want, it's okay. But at least know the impact. Accounting policy choices will have no impact on these three cash flows reported in the statement of cash flows. Whether operating, whether investing, whether financing. Maybe for this you might get one of the professional marks. And we will just check the requirement again just to know. Yes, they just told of the financial statements. Under financial statements, cash flow also can come. So that's how you are going to get the maximum marks for this. With this, I've finished this question. So see you in the next question. We are just left with 3 more questions. So we are 3 more questions away from finishing this revision kit. So see you in the next question. Till then, take care.